Everybody was making a lot of money from the stock market. So that's where I wanted to get into. Probably about 15 models that I trade. 12 or 13 of them are fully systematic. Number one rule of investing, I never believe anything I read about the market, even if I wrote it. If you gave this system to 50 different people and told them the exact rules of it, they would trade it 51 different ways. Pullbacks from highs tend to be more reliable buying points than pullbacks that are happening in a downward sloping market. The best marketers draw the most money. It's not the best performance.
Rob, thank you so much for taking time to speak with us today. When I think about systematic traders and researchers who have genuinely influenced how I think about markets, especially about seasonality and overnight edges, your name sits right at the top. A large part of that influence comes from the work you consistently put out over the years through your writing and research. For those of you who may not know Rob Hanna is the founder of Quantifiable Edges, a research platform dedicated to studying markets through data, statistics, and repeatable patterns. Rob is also widely known for his research on systematic trading, particularly around market seasonality, quantitative edges, and rules-based strategies. What makes his work stand out is that rare balance. It's rigorous enough for professionals, yet practical and accessible for independent retail traders like me who want to build robust, testable systems. Beyond his research and writing, Rob has extensive real-world capital allocation experience. From 2001 to 2019, he managed his own private investment fund, applying systematic and quantitative approaches across multiple market environments. He currently serves as a portfolio manager and investment advisor at Capital Advisors 360, where he continues to apply his research-first philosophy to diversified, systematic investment strategies. In all, what I have understood of Rob's work is that markets reward discipline, probabilities, and statistical humility far more than prediction. Rob, it's an absolute pleasure to have you with us. Thank you again.
Thank you. That was quite an intro. Some of that stuff you said is, I've never put it that way myself, and I like it a lot better the way you said it. So
thank you. Thank you. So let me start with the first question. When we think about I was listening to some of your interviews, so I have some context of your background. I understand you were born in the New Jersey area and you studied at the Boston University.
Boston College. The big difference.
Boston College, yeah.
Yeah, we're rivals, so you can't mix that up.
Okay. All right, it's Boston College then. And so my question to you is, you also said somewhere that while you lived in New Jersey, you had people who worked in Wall Street who would live in New Jersey, so you had some context about the markets. So my question to you is, when you were in college studying economics, what was your sense of markets at that point of time?
It was the wild market of the 80s, right? And we had the crash of 87 when I was a senior in high school. And, the movies that were coming out were like Greed with like Charlie Sheen and Martin Sheen. And then, it was Wall Street seemed very exciting. And you mentioned when I was in college, I got an internship with a firm on Wall Street. They traded Fed funds and euro dollars and things like that on a floor. And that was my first experience of like being in a pit. And so that was interesting. And most of the day, you trading bonds is pretty boring. There's not a lot to do. But when news would hit, everybody started screaming. And my job at that time was there wasn't an electronic board that showed the bids and offers. It was a giant like magic marker board. And I was the guy with the magic markers writing the bids and offers on each side. And so, a quick little story is the first day I got to work there, I was a junior in college and I was always good at math. And the guy says to me, how are you at math? I'm like, good. He says, your fractions? I was like, yeah. And he goes, no, you don't. Not when you got 30 people screaming at you. You got to know, what's higher or lower, 3/64ths or, 1/16th, and everybody's yelling at you. So go sit in the corner and study your fractions for for a couple hours. And so, but that was what I did. I wrote the bids and offers on the board in magic marker, and we had like 3 different magic markers in our hands, different colors for different banks and things like that. So it was interesting. So that was a great experience. And a couple things I learned there was, it can be exciting, but it also requires a lot of patience. There's a lot of sitting around. People don't trade. You don't want to trade just to trade, right? You got to wait for your opportunities.
My question was more in terms of, yes, you were in a specific market and a pit, but then what was your sense of, let's say, the larger markets in terms of, yes, there is an equity market, there are products like commodities, you were trading bonds perhaps, all of that. So what was the general broad sense of what is this thing called markets, and where did you see an opportunity for yourself there?
Everybody was making a lot of money then, right? From the stock market. So that's where I wanted to get into. I was interested in stocks. I didn't know how to trade them, so I started doing a lot of studying myself, and so I was initially drawn to the stock market. Although some of the people I knew growing up in New Jersey, friends of my parents and so forth, they some of them were bond traders, which is how I got my internship in the bond area. But stocks seemed that's where the movies were all about and stuff, right? And all the shows, and that's where you see, Ferris Bueller. Well, he went to Chicago, so they were trading commodities there in the pits. But trading places, that was again orange juice futures. I don't know. It all seemed exciting to me, and the stock market is what they flashed on TV at the time. So that's what I ended up starting to study.
Got it. Got it. Then you moved to you joined Thomson Financials and you were working there for a while. My question was, what were you reading at that time in terms of to understand the markets? Because you were also developing your own skills, I understand, during this phase at a more personal, individual level. So my question is, what were you reading? Who were the people you were following to get a sense of the markets at that point of time?
So there was a couple different avenues I was from an intermediate term trading standpoint, William O'Neill was an influence. I was looking to play breakouts and learn technical patterns and things like that. From a more of a swing and day trade type perspective, the first site I really started following was tradehard.com, which probably not a lot of people remember, but that became tradingmarkets.com. Larry Connors ran the site, and Dave Landry, who's still around, does great work. And then Jeff Cooper was another guy who wrote several books that I liked. But those guys had a lot of ideas, and there was software even back then that Jeff Cooper in his hit and run books had little patterns that he would look for in stocks. So it was like a Gilligan's Island setup or a lizard setup or whatever it was, and they didn't have stats behind them at the time. I was able to program into this software I had that would look for lizard patterns or Gilligan's Island patterns or whatever it was, and then I would look to trade them the next day. So I kept stats of my own on what am I making money in and what patterns aren't working for me. And that kind of led me to, all right, when am I making money? When am I losing money? And by keeping statistics on my own trading, that was the first analysis I did on myself and on trading. And so then over time, I learned to program better myself and develop my own patterns and ideas and kind of retest everything I learned reading in books.
And what products were you trading at this point? Was it stocks or indexes, futures, options? What exactly was it?
It was almost entirely stocks. Like late 90s when I was doing a lot of this. And, it was the internet bubble. I traded a lot of like IPOs. I had a pattern I called my second day runner pattern, right? And it was basically if an IPO comes out and it goes up by like 50% on the first day, as soon as it goes above that first day high on day two, I buy it. I mean, that's the whole thing, right? And then I would stay in it for somewhere between 10 minutes and a day. The movements were pretty incredible. Like it could, it would, you know, a 20% move wasn't that big of a deal in minutes. You know, you can see things double again the next day or go up 50% the next day. And of course, they'd go the other way also. But new internet stocks moved like meme stocks you know, a couple of years ago. It was that kind of craziness that was going on. So it was certainly an exciting time to learn to trade. And that's
Did you test these patterns, this IPO pattern? Did you, or was it just an observation at that point of time?
It started off as an observation, and I did it, and I kept stats on myself, and
you tried it on all new IPOs.
Yeah, and it was like my favorite pattern for a couple of years. And then 2000, you know, the market started to crash, and we got into a bear market, and it stopped having IPOs for a while. You know, mostly the IPO market basically dried up. And then when it came back, it was never quite the same. You know, you don't see a lot of IPOs that are doubling and tripling on day one anymore.
Got it. So the way I see it is, so at this point of time, you still had a bit of coding skills because you were testing stuff, but it wasn't 100% systematic. So there was a discretionary aspect to your trading, and you were also testing it. How did that evolve over time in terms of when did you start as a discretionary trader, a fully discretionary trader, and then move to systematic, or how did that evolution happen?
Well, I would say in the beginning it was, I don't know if you'd call it fully discretionary, right? Like my entry timing was based on some pattern, right? So whether it was like one of Jeff Cooper's patterns or a simple pattern that I came up with myself or a Dave Landry pattern, for entry, I always had some type of setup. And even the intermediate term stuff, like the William O'Neill stuff, you know, I was looking for a breakout of a cup and handle. It wasn't just I'm going to study a company and I think that company is probably going to do well over the next few years and I'm going to buy that company type of discretionary. It was, you know, what charts am I seeing that look like the stock's ready to break out and I'm going to keep an eye on that, or have set up in some type of pullback mean reversion type pattern that I think I could make some money off of. And it might just be, you know, you got a strong stock that pulls back for 3 days. That was the pattern, right? But I didn't necessarily have stats on what happens if I did this for every stock in the S&P 500, or what happens if I chose the stocks to trade by, you know, their volatility measures or relative strength or whatever it is you want to use as ranking systems. So there was no ranking, there was no real filters other than, you know, what popped up as in the news the day before, or what's gapping the most today. That was kind of the filtering I used. It was, you know, trading the hot stocks.
So the stock selection was in a way discretionary. Your entry was rules based. How about your risk management at that point of time in terms of stop losses? Was there a specific rule, or did you have some limits to your losses?
Risk management, that's something you kind of learn, right? So I think I started off with like a $10,000 account and traded it down to like 6 and then up to 20 and back to 8. You know, so it was a small account that went all over the place. That would, you know, my accounts these days don't double in a few months or get cut in half in a few months. That hasn't happened since
the 90s or 80s.
Yeah. Or maybe early 2000. But yeah.
So my question to you, Rob, is the advantage of hindsight that you have today. So are you a fully systematic, rules-based trader or investor, or there's still some discretion that goes into your trading today?
I've got a number of models that I trade. It's probably about 15 models that I trade. And I would say 12 or 13 of them are fully systematic. And then I still have a few that I use some discretion with. But the ones that have discretion, it's still based on quantitative data. So if anyone reads like my newsletter, what I'll do is I'll put trade ideas out there for the S&P 500 sometimes. I kind of go through all my studies, so that are active at the time. So we might have a Fed day tomorrow, and we're in a pattern that looks like the Fed day's probably got an upside edge, and we'll have maybe we got a 3-day pullback from a 50-day high or something like that. And today was an especially weak day, and so you often get a bounce the next few days. And simple little studies like that. So I might have 4 or 5 studies that are saying, over the next 1 to 3 to 5 days, there's a good chance we're gonna bounce. And then what I do is I take that information. I say, all right, we're oversold. We've got a lot of evidence saying we're likely to bounce here. I'll take a position, and that's discretionary, right? I'm saying, all right, I'll take a quarter of a position now or half position now. But it's discretionary based on quantitative evidence. And so I do that some with index trading, the S&P, and then I know you don't trade the VIX in India, but I do it some VIX trading too, and some of my VIX models. But some of them are also, I've got S&P models that are fully systematic, and I've got VIX models that are fully systematic, and I've got some that are more discretionary. And it's mostly discretionary in terms of how aggressive I want to be. It's not necessarily whether I want to take a signal or not. It's more how strongly do I want to take that signal, because the system doesn't know of a news event that I know is coming in a few days, or the system doesn't know of some special circumstances, or one system could be saying, yeah, let's get long, and I could have other systems saying, no, there's a downside edge. So the ones that are discretionary, it's mostly just to the degree I want to take a long or short position.
Some people call that data-informed discretion. So it's something like that is what I feel. So you are taking a lot of inputs from the data, but then the last decision to deploy or size the trade is discretionary.
Yes. So I like that. What was that term again? Data-informed?
Data-informed discretion, yeah.
All right. I like that. I'm going to steal that sometime.
Sure, all yours, Rob. I've stolen a lot from you, so I'm more than happy that I have something to share with you. Okay, so I'm going to go into a question about, because I like the kind of edges you figure out. So my question is, if a novice researcher comes to you and asks you, where do I find ideas for these edges, what would be your answer? From where do I find edges? Be it stocks, indexes, or any product.
Yeah, first of all, it's just basic curiosity. And my database of studies has, 1,400 studies that get identified, that get looked for in my database every night. When it had 0, all I would do every night is just say, all right, well, what did the market do today? And what's happened after that's happened in the past? And so it's basically just describing to yourself where we're at. What I was trying to uncover is, hey, I'm in a long position, or I'm in a short position, or I'm in no position, whatever, it doesn't matter. Is there an edge right now? So, looking at the market right now, we're close to hitting a new high, and we hit a new high yesterday. So you could say, all right, this is the second day in a row that we hit a new high, and today's bar is bigger than yesterday's, and whatever it is that you see that the market did that day, or has done over the last few days, code that, see if there's an edge. And it can be, and you mix in whatever you can. Hey, it's it's not just price action, but and volume's coming in high today, or volume's coming in low, or breadth is really good, or there's so many indicators out there, sentiment type indicators. And you can even mix in seasonality. Hey, we sold off really hard today, coming off of a high level, and it's Friday, right? So does that matter more, right? And just to give away a little something here, hard sell-offs on Fridays do often see a pop on Monday or Tuesday, because my theory a long time ago on this was that the two biggest crashes, 1929, 1987, happened on Mondays, right? So people were afraid of Mondays. And interestingly, I haven't looked at it in a long time, but there was a chart I used to show of Monday performance. And for years and years, it was down. Like Monday was the worst day of the week. So a lot of people got trained to sell on a Friday so they could avoid the Monday selling. And then after the worst Monday ever, which was 87, the pattern changed because people were so afraid of Mondays that they were selling out on Fridays, and then you'd get the move up on Mondays. And I'm not sure where it is right now. I haven't looked in a couple of years, but Monday used to be a bad day, then it turned into a good day, and so there is seasonality out there that sometimes means there's reasons behind the seasonality sometimes. OpEx is another one here in the U.S. where you have flows going into options expiration where that could matter.
So, so when you were, in the process of putting these 1,400 studies together, did you also read papers or books and figure out, okay, so for instance, since you said you used to read Larry O'Connor, so he used to have a lot of these setups, I remember. So did you test those and create your own out of those? Did that feed into?
Yes. I would test ideas I found places, and some of them were in books like Larry Connor's, but like my favorite book of his was How Markets Really Work, right? Because he would test the simple, what happens after the market's down 3 days versus up 3 days type stuff. Yeah. So I found that just a really useful way to, hey, let's look at the stats after these simple patterns happen. So that's one way you can go and test these kinds of simple patterns. What else was I reading? I would test anything that I could read, and or even that people would say on TV, or if I didn't have an observation of my own. It's, hey, what am I going to play around with? So I used to have a slide when I would give presentations, and it would say my number one rule of investing is that I never believe anything I read about the market. And it would say ... and I go to the next slide, and it would say, even if I wrote it. Right? Because markets change over time too.
Yes.
Right? So the Monday thing that I talked about, that changed. And any of these patterns that look like they have an edge, that can evolve over time. So another example I'll give, the NASDAQ composite in the U.S. started in 1971. From 1971 to, I think, 1999, on the last day of the year, it went up every time, 29 years in a row. After that, it went down on the last day of the year, like 10 of the next 12 years or something like that. So things change. I don't have any explanation for it. There may not be any rhyme or reason for it, but you need to keep updating your research because the market does change. And so some ideas, and you can get ideas from anywhere. Anything anyone says on TV, anyone says, oh, the market's up today because of this. All right, well, let's see, how does the market do when whatever the this is that they're saying happens? And there's a lot of things out there that you can debunk with just some simple research.
Got it. And I'm also curious, pre-internet, so once you had quantifiable edges, I'm sure there were a lot of people who were interacting with you and ideas flow that way. Would you spend time with other traders before this quantifiable edges community happened?
Yeah, and just people in my office that traded. I mean, the internet was around the whole time I was trading, because I really started trading in the mid 90s. So, but there wasn't a whole lot out there. Like, Trading Markets was the one site that I followed a lot. And there were some others that I'm having trouble thinking of right now. But yeah, just talking to other traders. There was chat groups back then. I got into some chat groups with some people, and like bulletin boards, forums. Ideas are everywhere. So I eventually started I wrote for Trading Markets for a few years. When I was talking to Larry Connors, there was a system I was going to put out there. I was like, I don't know. This looks really good to me, and should I be sharing this? What if it's my one good idea? This is like probably before I had any good ideas. But and his comment to me was, you know what? If you gave this system to 50 different people and told them the exact rules of it, they would trade it 51 different ways. Like, everybody thinks they can make it better. Everybody thinks they can do something different.
Absolutely.
And it's completely true. And the other thing is, put ideas out there. Don't feel like you got to hold on to anything, really, because once I started writing and blogging, the amount of feedback you get back it's pretty great. Like, hey, Rob, I see this. Did you ever think of that? Or did you look into this? Or, sometimes if I messed up on a study, I'd get called out on that too. Like, I don't think you missed this day, you missed that day, or I don't think you filtered for something or other that you say you filtered for. I'm like, all right. So it makes you accountable, and it gives you a ton of ideas. Don't be afraid to share ideas with other people you know and trust, or even strangers that you don't know, because you get a lot of feedback back. So that's been very helpful to me in my career. It's just putting stuff out there and seeing what comes.
I'm sure it does. I've experienced something very, very similar, because I think about a lot of strategies myself, and when I put it out there, people share all sorts of ideas, and it only gets better. I've never seen it get worse when you share an idea outside. So I get it. I have a question about how your backtesting abilities evolved over time, in terms of did you get statistically better tests later, or how did that happen? Because you were dealing with data earlier, but then how was the evolution of the quality of backtesting that you were doing?
Yeah, so that evolved over time as well, where, like I said, my original studies were on the simple setups I did. And that was just me keeping a spreadsheet, basically, and being able to run filters and see how the trades did. And then the first real back testing software I used was TradeStation. And TradeStation's really good at testing simple ideas on one market at a time, right? So if you're looking to trade the S&P 500, or you're looking to trade the Nifty 50, or you're looking to trade the Qs or whatever it is, or some commodity, the language in TradeStation's pretty easy to learn, and it's very easy to just apply a few simple ideas to a chart, and entries and exits, and see how your idea would have done over time. So TradeStation was the basis of most of what you've seen over the years on Quantifiable Edges, as far as the simple edges that I publish. Later on, I became introduced to AmiBroker, and AmiBroker is really good at, if you want to run an idea on a portfolio of stocks, right? So do you want to you want to buy whatever pattern it is. It doesn't matter if it's a trend following pattern or a mean reversion pattern or whatever it is. Rather than just saying, hey, I'm going to allocate my full amount to this trade, you can say, all right, I want to put 5 or 10 or 15% of my money or whatever it is into each trade. And these are the rules behind it. And this is when I would get out. And I only want to trade these stocks if they're currently in the Nifty 50 or the S&P 500, or whatever your index is. In conjunction with AmiBroker, I use I use Norgate data. Do you have Norgate data in India?
Not, but I know what it is. I would read a lot of content and blogs from the US, and that's how I know there's something called Norgate.
Okay. So what Norgate does really well is that it tracks when something is in and out of the index, right? So it makes it easy to filter and say, so like your Nifty 50's changed, dramatically over the last 30 years. If you want to run a test back 30 years, you got to know when a stock is in it and when it's not in it, right? So AmiBroker can do that. That was able to give me more sophisticated results. It can be a little challenging to program in, so I did need to, hire outside programmers for some of it. In the last few years, I've also begun using Real Test, and so some of the stuff you see on the site now is Real Test and some of the AmiBroker. My son knows Python and R, and those are other languages that people can use, and so he's recreated some of the things I've done in Python. There's a lot out there now where you can say, hey, my idea is I want to buy anytime the RSI2 goes below some certain number, and then I'll sell it when it pops above a certain number, and I'm going to do that in Nifty 50 stocks, but I only want to trade in the 25 least volatile ones or whatever it is, or most volatile, whatever you want, and let's see how that would have turned out over time. And you can create that in a matter of hours or days, depending on how talented you are with the programming, and see what the chart pattern would have been, and then adjust it. So those are the tools that I use, and there's some others out there that are very good as well.
Now with AI, it's become very easy. So you don't need to know the syntax of a language. You could just describe it.
Yes. Yeah. And so I haven't done a whole lot of that, but I know traders that are like, oh yeah, I program in Python all the time now because ChatGPT or Claude or whoever taught me how. And and they don't ever actually create the Python code. They have Claude or GPT create the Python code and then just plop it in. Yeah.
So my question was also about, let's say, did you attempt stuff like in-sample, out-sample tests, and then to make your backtest more robust, did you try things like that? And did that help? Or do you recommend stuff like that?
In and out of sample can help, but I do like to see a consistency over the entire period, right? So, some people get a little too fine in their choosing their in and out of sample periods, right? That's just another way you can manipulate the data too, by saying, hey, well, if I choose the right period, it's going to look better for and so I'm more concerned with, if we got 20 years of results, 18 or 19 of them positive, that's pretty good, right? If you get all 20 positive, that's even better. But you also don't want to do that much data mining. You don't want, so when building a system, this is something that I did very early on, where I'd be like, all right, all these trades came, these hypothetical trades would come in. It was this terrible trade in 2008, or this terrible trade when, we had this thing happen in 2015 or 2016. Actually, I was pretty much past it by that. But early on, like the temptation is to, how do I get rid of those trades, right? Oh, if I can filter on times where what was happening in the market leading up to that, let's filter that out. That is the worst thing you can do, right? Do not try and filter out periods of time to fit your system. What you want to do is just make sure whatever the idea the system is based on is providing an edge. Can you get an edge trading some breakout pattern? Can you get an edge trading some pullback pattern? And if there is an edge there, okay, let's think about a reasonable way to identify when there's a high probability of getting a move. And then let's think about how we want to get out in a reasonable manner from those systems, right? And they're two completely different things. A lot of people, sorry, I'm getting off track here.
No. Okay. Go ahead, please.
A trend following system, your exit should be looks like the trend is ending, right? So you want to ride that trend until it looks like it's not happening anymore. So that can be a breakdown. It can be a break of a moving average, anything like that. A mean reversion system, in that case, so basically you're always getting out with a stop in a trend following system. Something's got to go the other way for you to get out, and that's how you're going to make your money.
Trailing stop.
Trailing stop. So figure out what your trailing stop is and what makes sense. And it could be it breaks two levels of support. It could be it breaks moving average. It could be whatever you see as this is going to mean the idea is no longer working. Mean reversion system, on the other hand, your exit has got to be, I'm expecting the mean reversion to happen. When it happens, get out, right? Like instead of waiting for a breakdown, and this is why stops don't work nearly as well or at all with most mean reversion systems. You're buying when it's kind of collapsing. You're expecting a bounce. When the bounce comes, you got to get out. So that can mean, if it's an RSI system, your RSI is going back above 50, or you're back above a moving average, or you're hitting a short-term high, or whatever it is. That's when you're getting out. But in a trend following system, that is not when you're getting out. So see when you're more comfortable getting out. A lot of people don't have the personality for both, and you'll prefer one over the other. But it is, if you can mix them together and have some, I prefer mean reversion for most of my trading. So I need some trend following, and that's the lower part of my portfolio. But there are people that are more comfortable with trend following. They should have some mean reversion in their portfolio.
Got it. So I see what you're trying to say is with mean reversion systems, you've got to have a target, and with trend following anyways, the trailing stop loss takes care of it. I know this could be a stupid question, but why can't I have a trailing stop loss for that mean reversion trade?
Well, most of the time in a mean reversion system, you're buying because it's hitting some extreme, right? So it's and by an extreme, that could be we're at a 5-day low. It doesn't have to be that extreme, or it could be you're below a Bollinger Band, or your RSI is below a certain number, or something like that. So you're trading when it's extremely, or it's oversold. When it goes against you, and it becomes more oversold, you could run a test of a system that says, all right, rather than buy when the RSI goes below 20, let's run the same system when it goes below 10. And what you'll probably find is that if the odds aren't better, they're at least about as good, or you've still got positive expectations when you're at that level. So that's why it doesn't necessarily work putting in a stop in a mean reversion system. Years ago, I did one with RSI2, right? And I just did it on the S&P 500. I think it was RSI2. Anyway.
I think so too. I remember that.
Oh, do you remember it? Okay.
Yeah,
so
I do.
I wrote it was a little mini white paper I did on stops. And what I found was, the idea of putting in a stop is so that you avoid catastrophe, right? Now, if you're trading with tons of leverage, then you probably shouldn't be trading mean reversion. But if with the S&P system, what I found was, and I did it with, I think, SPY. You buy RSI2 when it goes under 2, or you buy the S&P when the RSI2 goes under 2, and you sell when it goes over a certain amount. And I said, all right, let's put in a stop. And I said, what was the worst pullback that there was using that system? And it was like 15%. So I said, all right, let's say we did a stop, percent stop, anywhere between 1 and 15%. And what I found was the overall profitability was lower using every stop level. And that's not a big surprise. But the worst trade was worse at nearly every stop level. Like once you got down to say a 5 or 6 or 7 or 8% stop, your worst trade was worse than having no stop at all. So the point of it was, hey, let's avoid a catastrophic loss. But what you were doing is creating more big losses for yourself. And so the average trade went down, the average loss was bigger with stops, and the worst loss was bigger with stops, because Even with like in the example I ran, if it was say an 8% stop, your worst trade was like a 10 or 15% loss because it happened when there was a gap down, right? So you'd be off 7%, you'd look to sell the next day, and the next day, for whatever that 7 or 8 or 10% gap down in the market or something, it didn't just make your overall profits worse, it made everything worse. And so that was a lesson for me when I ran that. I'm like, wow, that's something. So I generally don't like using stops in mean reversion systems.
So, how do we manage risk with mean reversion systems then?
Size, right? So you got to make sure you're not trading too large of size in relation to your overall portfolio. And so certain models that I run, for instance, if I have a model that I trade S&P 100 stocks with, and so they're the biggest stocks. And with mean reversion, I found that a lot of times you're better off trading large stocks than you are small caps, because with small caps, you're more likely to go to zero than you are. There could be, you don't get the bounce isn't as reliable. And I think the reason behind that is that there's not as many institutional owners, right? So if you buy some tiny stock that has one or two institutional owners and one of them wants out, they can push it down day after day after day trying to get out of their position. If you're in some large cap stock that's got 50 or 60 or 100 or more institutional owners, one of them wants to get out, there's a few others that probably want to get in, right? So that's why you get more reliable zigzags. And that's why mean reversion works better in large caps. And I almost forgot the question. I got sidetracked again.
That's okay. So we'll get back. We'll get back. So I had this question. Since we are talking about mean reversion, Rob, why don't we wait for the price to kind of move in our favor, in our direction, rather than buying it at that low?
Oh, wait. The question was sizing. So anyway, I don't want to put more than 2% or 5% of my portfolio, say, into one of those. Then if it's a model that would take 5 positions, then I can only have it as 20% of my portfolio. So sizing will matter. All right. It matters less when you're trading like a big index, because an individual stock has more risk than a large index, right? You got diversity within the index. The question, this one was mean reversion.
This one was about, so we were talking, since we are talking about mean reversion, I said, why don't we wait for the price to, move in our favor and then we enter, rather than, what they call trying to catch a falling knife. So why do we do that? What has been your experience with it?
So some people do that. They like doing that. They say, we get a 3-day pullback and you buy when it moves back above the previous day's high, right? Or something like that. In most of the research I've done, I haven't found that to be as effective, because you tend to miss too much of the move sometimes, or too many moves. Some of the models might look for an extreme move down, right? And because it's an extreme move down, it takes quite a bit to get back up above the previous day's high or the high of the last couple of days. And then there also isn't as much upside potential after you've already made that move. So I prefer just going in when it hits my extreme with a reasonable size position. There are some systems I've done over time where I'll scale in. So you can also think about doing that. I don't do that as much these days because I diversify among many different models. But if I was trading like 1 or 2 models, then I would say, all right, I want to scale in more with these positions just to be sure.
How would you manage size in scaling in? Because there'll be certain trades which work in your favor without giving you an opportunity to scale in.
Exactly. So that's kind of the trade-off. So when you're evaluating your system, one thing you can do is look at each part of the scale-in as a different system, right? So what if I were to trade only when the RSI goes below 10 and I buy the next morning, right? what if I were to only trade when the RSI closed below 10 yesterday and today, meaning, I've already got a position on. Or more specifically, if it closed below 10 and never got back above, my exit level, say 50, and then a second signal hits. What's the value of trading that signal? And then what would be the value of trading, say, a third signal there? And evaluate those as individual systems. And you might find that, waiting for the second entries would make you more money, in which case you adjust and wait for the second entry. You might find that waiting for the second or third entry is going to lose you a bunch of money because you're missing out on opportunities, in which case, okay, let's only take one entry with this model and maybe look for more stocks to put it in if you're putting it in stocks, say. So rather than taking up to 5 positions, I'll take up to 10 or 15 positions, and that way it'll be a smaller amount of my portfolio, and I'm not putting quite as much at risk with each individual trade.
Since we are at mean reversion, so I had another question. So when you test a strategy, you could be testing it on stocks or spot on an index. On what basis do you choose the product after that? So how do you figure out whether you would test it on spot and then trade it on futures, or test it on spot and trade it on options, or do you test it on the tradable product itself? How do you do that?
Well, so that depends a little bit on the model. So if it's, say, an S&P 500, if it's looking at end-of-day data, then I will often just use the index. If it's looking at intraday data, then I will use the actual security that I would look to trade. And the reason for that is that the only real number for the indices, so the S&P 500, say, is the close. Nowadays, we've got electronic opens, so you do get gaps for the S&P 500, and it's pretty accurate. But you look back 25 years, and the open wasn't really the open, because what would happen is you'd have delayed opens on a lot of stocks, especially on days when there was a big gap. So the only real open was SPY. So you might see SPY gap down 4% or gap up 3%. And if you look at the S&P 500, it was only a 0.5% gap or something like that, because the first tick on the S&P 500 didn't include 2/3 of the stocks. They were still pricing in whatever yesterday's price was. So that's something that people need to keep in mind when they're looking at historical charts. If I'm running it on a portfolio of stocks, I always just use those stocks, and I'll use open, high, low, close, and I'll make adjustments for would I have gotten a fill? I always like to say it's got to go at least a penny below my limit price if I'm using a limit price to get me a fill on a long position. Otherwise, if it goes right to it, it's not a fill, and maybe in real life I would have gotten it, and maybe I wouldn't have. So I don't count it.
Got it. At some places, I'm not sure if my memory serves me right, but then I remember you've said options work better for certain setups because your risk is, especially long options or buying options, works better for certain mean reversion setups. So what was that, if you had said that?
Well, the nice thing about options is that you can define your risk, right? So part of the problem with using stops on a mean reversion system in, say, the S&P 500 is that you'd get this big gap. You can't control gaps. And even, there could be a flash crash again, right? Like happened in 2010, where if you had stops on a bunch of ETFs, it would have gotten blown through. You're not going to get filled at your stop price. So you may never get a stop. Doesn't mean you're getting out at that price. It just means that's when you're gonna get your sell triggered, and
you would want to get out of it, but then there's no guarantee that it would.
Right, you might get filled 10% below there. With options, you're getting out at that price. Like what your absolute biggest loss is. So if you're looking to buy a call on something that's a falling knife, as you were saying, you can lose everything on the call, but most people aren't putting 100% of their portfolio into a into a call option. If you do, you won't be trading long. But so you can take on a good amount of size using options and still have a relatively small loss, right? Say, oh, I only want to lose 2% of my portfolio, then you got to choose an option that only represents 2% of your portfolio, and you can certainly set up more complex options positions as well. It's not just buying a call or a put.
So how do you deal with time decay? So do you have rules about, you would buy a call or a put which has a minimum, let's say 15 DTE or a 20 DTE or something like that? Do you have some rules around that?
Yeah. I don't do it as much anymore because I trade so many different models now that I don't necessarily need to protect each individual position with options. When you're looking for a mean reversion, if you're expecting that the reversion should take place at some point over the next, say, 3 to 5 days, then I would give it longer than that, right? So maybe give it 2 to 3 weeks so that you're not seeing a whole ton of time decay on the option. You can also deal with options that are, deep in the money, right? Because there's not a lot of premium on them anymore. Now, if you're dealing in individual stocks, you do run the risk of, having things called away as well. But, if you're trading options that are in the money, then there's, the time decay is not a problem. If you're trading stuff that's out of the money, time decay will get you.
Yep. Got it. I'll move on to my last question in the context of backtesting. Okay, so you did tell me that you look at a broad set of data. It could be 10 years, 20 years, or that kind of number. Now, are there specific metrics that you look at when you are, testing a strategy? So what would those few key metrics be which are important for you over years that you realize, it makes sense to look at?
The number one metric for me is simply the performance curve, right? So I want to see if it's consistent. So you can look at it as the curve, and you're probably better off looking at the drawdown curve, though, because when you look at a profit curve, say if it's a model that's run for a long time, a 25% pullback may not look like much when you're 20 years in the future, because it's a small number if it's not if your chart's not adjusted. So looking at the drawdown chart is good, and making sure that there aren't huge drawdowns along the way. Also, the time to recover the drawdowns is very important. There's plenty of statistics out there. Sortino ratio I like a lot. The Sharpe ratio is good. Profit factor I look at, so I have some idea of what the gains versus losses are over time. Percent profitable is important for mean reversion systems, right? Because a trend following system is not that important. Trend following system, you can have 15% of your trades work out well, and that can be a very profitable system. But a mean reversion system, you probably want to have 2/3 or more making money. I would say 2/3 at a minimum. So I look to make sure that that's been steady over time. And then also look at those on a year by year basis, right? So rather than just saying, oh, this has made money on 65% of the trades or 75% of the trades or 80% of the trades, how is it done year by year, right? So in the bad years, did it only make money on 40% of the trades? Why is that? What happened that year? And that'll let you know what kinds of markets that model may not do well in. It's nice to have. I guess the other thing I look at is correlation, both to whatever you're trying to beat, right? So if you're trying to beat the indices, you want to see what the correlation to the indices is. High correlation isn't necessarily bad with the market, but you want to see correlation among your own models, right? As low as that is, the lower it is, the better. So if I've got a good mean reversion system for S&P 100 stocks or Nifty 50 individual stocks, I can create another system that maybe looks a little bit better. And should I run them both at the same time? Well, you might be trading basically the same thing, right? One trades percent B for Bollinger Bands and the other trades, RSI. It doesn't really provide you any value. So looking at correlation among your systems is a good thing. And I like to have systems that tend to do well when others do poorly.
So that you get a smoother.
Yep, smooths out the whole portfolio.
I'll move my conversation towards market breadth, and another area which interests me, and you've done a fair bit of work there. I know you use it as one of the inputs in trades, but then I just wanted to get a sense of how your understanding of market breadth has changed over time. And because I see some extremes when I read, especially literature, there are people who say breadth makes no difference, and then there are people who use breadth as a signal. So, and I know you do use breadth. So how do you look at it, and how has your view changed over time?
Breadth can be used a few different ways. One is I found breadth thrusts to be something valuable to look at when the market has had some type of extreme sell-off. Like last April when we had the tariff tantrum. The market has now gone up strongly based on breadth over the last couple of weeks or days or whatever it is. And they tend to do a good job of identifying reversal points, right? So
So you mean divergence in terms of price and breadth?
not necessarily divergence. They'll confirm that the move up is for real, right? So if you get a big bounce off of a sell-off and it's a narrow bounce, like there isn't a whole lot of stocks participating in that bounce, then it's less likely that you're going to have continued follow-through, right? There's a lot of people that have done studies on that over the years, and that's Walter Deemer's got good work on that, and breadth thrusts tended to do well at identifying potential when we've reached the potential bottom of the market and we're moving higher. Now, breadth overall can help to signal tops as well, right? And it's not necessarily, so if we get a breadth divergence when the stock market's moving higher, that says, all right, we might see it rolling over. It doesn't really guarantee anything because the divergence can resolve itself.
That's what I've seen.
Yeah. So if you're looking at like advanced decline line, or if you're looking at net new highs, new highs minus new lows, and that's lagging while the market's moving higher, that's a potential problem, but the breadth can catch up. So it's more interesting to me when breadth is confirming, because what that tells me is, hey, we're unlikely to have a strong sell-off in the next 3 months now that we're hitting new highs and the AD line is also hitting a new high, and the number of new highs in the stock market is also hitting a new high. Everything's getting bought. It's unlikely that we're going to get some reversal. There's no big cracks under the hood at this point. And so that's more of a confirmation that all is right with the market, and that liquidity is plentiful, and that even the crappy companies are getting bought, and that people are willing to put money into the market. And it's when you get the divergence where everybody's being real selective about what they want to push higher that maybe it's just the mega caps that are making the money that you're in danger of rolling over. But again, that can resolve itself, but you got to be aware of that danger.
So do you use breadth by itself, or do you combine that with some other indicators and some other parameters too?
I use breadth as a market indicator, right? So it's not, I don't have a model that I trade that just says I want to trade based off of breadth, but I use it in setting my general market bias, and that market bias does act as a filter for some of my models.
And have you seen any difference in the breadth of indexes which have lesser number of stocks vis-a-vis, indexes which have greater number of stocks, or in any value in looking at breadth based on the market cap of the stocks, all of that? I mean, I just kind of want to geek out a bit whether there are things which work better than others when it comes to breadth.
Well, yeah, I mean, like any of the information can be valuable, but you just kind of got to be aware of claims that people might make. So people might point out the fact that, hey, the NASDAQ's hitting new highs, but the NASDAQ composite breadth is really lagging. Well, NASDAQ breadth is not worth much. It's never hit a new high. The NASDAQ, when it first came out, was smaller companies. They didn't have the same stringent listing requirements the S&P did. And so if you look at the advanced decline line of the NASDAQ from its inception, it goes like this. Whereas the New York Stock Exchange goes like this, right? So you'd start off as some small risky company, you list yourself on the NASDAQ, and then if you got legit, you'd move yourself to the New York Stock Exchange. So that's why those are like NASDAQ breadth to me doesn't mean it as much. But if you're looking at like S&P 500 breadth, I think that's worth looking at. I've found some value there. I don't look at Russell 2000 like small cap breadth individually necessarily, but because I'm looking at New York Stock Exchange breadth, I think that covers a lot of it anyway. The other thing I do with breadth that's a little bit different is I use something called my capitulative breadth indicator. That's basically a count of the number of triggers I have in a model that looks to buy individual S&P 100 stocks that are in capitulative selling patterns. But you can do that with any model you got, right? So if you're saying, hey, I want to buy anytime a stock goes, below its lower 20-day Bollinger Band, just count how many are below their lower 20-day Bollinger Band, or have gone below their lower 20-day Bollinger Band and not moved back up with a percent B above 25 or 50 or whatever it is in the last recently. So you can find breadth a lot of different ways, and I found that to be a valuable indicator for me. I call it my CBI, the capitulative breadth indicator.
Yes.
But
yes.
It's something that anybody can do with any of your models. I used to have an indicator I called my what's working, what's not indicator. And that was like, all right, are breakouts working? Are pullbacks working? And when you see a bunch of things that tend to be working, that gives you confirmation. So if you see a bunch of breakouts in the market that are working, that means you're probably in an uptrend. If you see a bunch of breakouts that are failing, it might be starting to roll over, right? So breadth can be looked at many, many different ways. And
Yep.
it's just another input that can be of real value.
I remember, reading your post about the CBI indicator, especially during COVID, because I think it would trigger quite often then.
Yes.
Yes.
It had a big spike then. That was I think that was the biggest spike ever.
Yeah. I'll extend the conversation from market breadth to market regimes, because you made an interesting point about breakouts. Now, at a very simple level, one way to identify a regime is whether the market is an uptrend or a downtrend. You figure out some kind of a trend filter. But then beyond that, if I have to kind of put different kinds of lenses on looking at market regime, what would those be? And which of them which are relevant and useful to look at?
With regime work, I don't think adding a whole lot of complexity helps. I do think, like you said, uptrend or downtrend, and feel free to define that any way you want. You can say above or below the 200-day moving average. You can say, are we in a golden cross or a death cross formation? Are we higher than we were 200 days ago or a year ago. My favorite breadth indicator probably is Dave Landry's. He calls it his big blue arrow. He draws an arrow on the chart and says it's going up or it's going down or it's going sideways, right? So it's going up, down, or sideways, and take a look at it. So uptrend and downtrend, however you want to define it, can be helpful. And that's something I looked at, like for long-term performance of the market. I looked across I did tests on S&P and NASDAQ and the Dow, and I went back as far as I could in history. And I said, what if we apply all these different indicators, like which is the best one? And best one kind of changed over time, right? Like, oh, you're better off trading Golden Cross, which is the 50-day moving average above the 200-day moving average. Or are you better off saying we're above or below moving average, or above or below multiple moving averages, like how many are you above or how many are you below? And then up or down in the year, and a few other ways, I can't remember. Anyway, I found that using a filter like that to say whether you're in or out of the market, depending on the market and depending on the time frame you're measuring, any one of those filters can be better than the other. But they're all better than doing nothing, right? So the portfolio always did better if you used a filter because it avoided the worst of the drawdowns. You didn't sit through the Great Depression in the U.S. or the 2000s bear market or part of the 70s bear market, or there was always something that you were able. The worst drawdowns, if the market's going to go down 50, 60, 70%, you're not going to get hit that hard. You will get chopped up sometimes, and over the short run you can make less money. Now the other thing you can filter on, if you're not inclined to just use trend, is volatility. And you can say, all right, you can either use something like the VIX or you can use realized volatility as well.
Which is range?
Yeah. Or range or historical volatility is a measure when I say realized. So the HV calculation. So you could do it by average day trading range. You could do historical volatility measures close to close, but there's many ways that you can measure volatility over the last month, quarter, 50 days, 200 days. The only issue with volatility is that it changes really quick, right? So if you're using volatility as a filter, it can increase very quickly when you have some market event, and then it could take a long time to go back to normal because if you're using, say, a moving average of volatility, then it takes a while for that volatility event to roll off the back. But volatility can be another way to say whether your system in a high probability or a low probability regime, if you want to use something other than trend. Seasonality you can also use. I mean, it's not really a regime, but there are cycles that have persisted over long periods of time. I don't know what ones would be most appropriate in India, but in the US, we have like the presidential cycle, which is a 4-year cycle, which there seems to be something behind it. There's the best 6 months, worst 6 months of the year. There's simple things like early month and mid-month tend to have some good days because that's when money goes into 401k programs. So all this indexing happens, right?
The turn of the month.
Yeah, turn of the month. And so there's periods of time where you're more likely to do better. So seasonality can be a regime filter also. You can define seasonality really, and people do decades also. I haven't found a whole lot of value in that, but early in a decade versus late in a decade, what years have done better. But I do find value in looking at things like week of the month of the year, and sometimes day of the week.
Mm-hmm. Got it.
So I would say volatility, seasonality, and then also back to our previous discussion, breadth could be used as a regime filter. So if there is a divergence that has persisted, if you make a new highs and you haven't had a new high in the AD line for the last 3 months or 6 months or whatever, maybe that's a warning sign that you can use in on a system, or if you've had a breadth thrust.
Got it. Thanks. That helps. I'm going back to mean reversion strategies a bit because a lot of that work that you've done is in this space. Now, if I were to ask you, what would be a simple or a robust way to design a mean reversion strategy? I know Bollinger Bands are there, and then you have RSIs, but then in your experience, does it matter? Or, these indicators don't really matter so long as, you have some kind of a measure.
They're all the same. They're all measuring price, right? So
it's breakout versus moving average crossover kind of a thing. They all are going to trigger along at some point of time anyways.
Yes. Right. So do you want to break out? Do you want to move an average crossover? Do you want to rank them based on recent performance, rate of change, all that with a trend following system? It's kind of the same thing with the mean reversion system. And you can do rate of change with the mean reversion system too, right? So rather than let's look at the stocks with the lowest RSIs, you could say let's look at the stocks that have the worst rate of change over the last 5 days. And maybe you also want to filter but they have a strong rate of change over the last 25 days, or whatever it is, right? So that means we're pulling back in an uptrend. I got a simple system, along those lines that it uses RSI, right? So what it does, rather than saying, hey, we want to get in when the RSI is below a certain number, it uses two RSIs. It uses an RSI 2 and an RSI 14. And the signal is we want the RSI 2 to be at least 50 points below the RSI 14, right? So for that to happen, the RSI 14 has to be above 50, right? So that means you're in an uptrend. And it's got to be an extreme move to get the RSI low enough that it's 50 points below the 14.
Below.
Right. So that's one way you can use kind of the same indicator
but different
to measure two different time frames, kind of, and see, hey, all right, we're moving strongly against the longer trend, and more often than not, that longer trend will assert itself, and even if it doesn't completely assert itself, you could probably make a little money on a bounce here.
Got it. And I remember in one of your interviews somewhere, I read this, and this is exactly what I think you said. The highest probability of a market crash occurs when the market is already in an extremely oversold condition. Now, this was an interesting one because you're saying it's already stretched, and that's when the odds of a crash happen. So
I don't remember saying that.
Do you remember that?
No, I'm sorry. I don't remember that.
Okay. All right. Okay. So this is, I think, what you're trying to say is when the market is stretched, or it's kind of oversold, and that's when the odds of a further crash increases, or something like that. I don't know. But it goes against the idea of mean reversion.
You're highly unlikely to have a crash coming off of a high, right? So,
oh, yes.
If the market is at a new high, the chance of it crashing is very low because it's got some momentum. It's not until the momentum turns that you would typically see a market crash. So if you look at most big market sell-offs over the years, like take 1987 for instance, like it was kind of falling apart starting in September or whatever that year. And the crash happened in October. Maybe it was August. It started trending down. The exception to that, though, was 2020, right? So that was really unusual because we were hitting highs, I think, third week in February.
Yes.
That was almost a forced market crash, right? Like the economy shut down. All restaurants were closed here in the U.S. Most stores were closed. Like they did the whole 15 days to slow the spread, they called it. And like everybody was supposed to be home. Schools were closed. Nobody was going out and buying things, except, everybody wanted toilet paper. And couldn't get it. And so that was such an extreme event came out of something other than liquidity or the economy faltering or something. It was forced upon us. So I think that was kind of the exception to the rule. If you remember, oil futures went negative. There was nowhere to put the oil. Nobody believed that could happen. How could oil futures go negative, right? So it's going down near zero. There's a bunch of people buying and they got slaughtered because it's negative $35 a barrel or something. And everybody's trying to look up, hey, can I have barrels of oil delivered to my house? I'll store them in the backyard for a while if they're going to pay me $35 a barrel. That was the one instance that I think you didn't see some type of deterioration before the crash. In all our cases, there's some type of deterioration before a crash. So pullbacks from highs tend to be more reliable buying points than pullbacks that are happening in a downward sloping market or a choppy market. Then you're in more danger trading mean reversion than you are if it's going higher, right? So
now I get a sense. And moving on to overnight strategies, which are based on the overnight drift, have you have you seen any kind of filters which are useful or to select days which have better odds than a usual day?
yeah, so one of the interesting things I found about when I trade overnights is that they do follow mean reversion and seasonality tendencies as well. With the S&P 500, if you get strong selling at the end of the day, a lot of times a strong reaction is an overreaction, right? So people want to get out ahead of something, or they're being forced out. There might be some big liquidation going on. So those kinds of days tend to result in a gap up the next day. From a seasonality standpoint, there's certain days that tend to do better than others as well. Like turn of the month tends to be a pretty good day for finding gaps up. Another one is if you look at just days of the week, Friday tends to be a pretty good day to take overnight risk. Now, if you think about why, there's a lot of why a Friday would be better than, say, Monday or Tuesday. You're going to be in that trade for the entire weekend. So anyone that day trades in the market, the reason they day trade is they don't want to take overnight risk, right? And so assuming there is such a thing as overnight risk, if you're an overnight trader, you consider yourself, the person that is taking that risk and being paid to take it. You're almost like the insurance company, right? There's risk on individual days, but over time, you should get paid out. Well, if they're paying you for Friday, Saturday, and Sunday night rather than just for Monday or Tuesday night, then you can demand higher premium. And so that's why gaps on Mondays, gaps higher, have historically been more reliable than gaps on other days of the week that I've found. So that's one example of seasonality there. But yeah, mean reversion, and you can measure that in a number of different ways. Again, you could also use breadth there. You get a really bad breadth day, that means they're selling everything. That means there's some kind of panic that's more likely to resolve the next day as an overreaction, right? Strong reactions are often overreactions, and you see that in both directions in the market. So if you get a really strong up day, you may want to not take the overnight trade.
Because that's going to mean revert.
Yeah. That strong up day was an overreaction. Could have been a bunch of short covering, for instance, right? People getting forced to buy, and they're not forced to buy the next morning, and there may be some bargains available, and so you'll see a mini gap down.
Got it. So just to be sure, so when you say a strong up day or a strong down day, are you using any other parameter other than rate of change there, or?
Well, yeah. I mean, you can use any indicator that you might use for a mean reversion system. You might want to use to measure that. So, say a short-term RSI or a short-term Bollinger Band or a rate of change or a percent rate of change. So let's say call it a relative rate of change, right? So
Got it.
when I say relative, like you could do a percent rank on rate of change. So is today one of the percent rank is a nice way, almost like a Bollinger Band, to put into context what the move is, right? So rather than saying I want to, anytime the S&P is down 1% of the day, I want to buy and sell the next morning, you could say, well, there's going to be periods of time where 1% move down is nothing, and there's periods of time where 1% down is huge. So rather than say 1% down, let's say, all right, if it is among the worst 2 or 3% of days in the last 100 days or in the last year, right? So, it's been, or the last 50 days, it's been a relatively bad day today. Or it's been a relatively bad 2 days or 3 days or 4, right? You don't need to just measure one day, but the same type of mean reversion principles tend to apply to overnight.
Got it. Got it. So that really helps. Now, moving on to the other side of overnight, which is intraday, have you seen any patterns between open and close, and any, be it seasonality, be it people talk about mean reversion on an intraday basis, so where markets gap up, but then during the day it kind of reverts to the mean. Have you observed any of that? Have you traded any of that?
Yeah, I mean, over the years, when I first started trading, I would do more day trading. I found that intraday trading was harder. Like I didn't find as many edges that persisted for the intraday. And then part of it's also my own fault. I didn't want to sit in front of my screen all day focused on the little movements. So I like to do most of my trading near the open or near the close, or I'll have, orders sitting there during the day. But I generally don't look to take advantage of intraday movement on a day-to-day basis where I would call myself a day trader. And part of that is I struggle to find real strong edges there, at least ones that I could take advantage of on a consistent basis. And part of it is just that I had other interests during the day. Like I'd rather do my research during the day. I want to, read up on the market. I follow Twitter. I answer emails. There's other things I got to do for my work day rather than sit and trade. So most of what I learn about the market has been done outside of market hours rather than simply observing patterns during the day and trying to take advantage of those.
Got it. So I know you said your style of trading does not work with intraday, but then does it mean there's no edge there, or
No, not at all. There's going to be an edge. I just in the traditional ways that I looked at things, I didn't necessarily find it the same way. So, for instance, mean reversion, right? If the market pulls back 3 days in a row, there's a pretty good chance you're going to get a bounce over, some point in the next few days. If you're looking at an intraday chart, the same thing is not true. If you're looking at, say, a 5-minute chart or a 15-minute chart or even a 30-minute chart or whatever, because momentum can really carry on the intraday, right? You get a strong move up, and that might get chased by short covering or FOMO or whatever it is. So those patterns, those mean reversion type patterns, I don't necessarily think apply to intraday that might apply on a day-to-day basis. When people have time between each day to step back and take a breath and say, all right, what am I going to do? Then it's not as emotional. There's not the FOMO. There's not the same amount of fear and envy.
So let me ask you, how do you define swing trading, and then we'll continue from there. I think that would be better.
Okay, so I look at swing trading as just looking to trade primarily off of daily bars and stay in trades anywhere from one day to a couple weeks maybe, and a lot of it is kind of mean reversion type strategies, right? I mean, you can play breakouts for swings. You're basically looking to identify an edge, get into it, and then take your profits in a few days, hopefully.
Got it. And you do that primarily in stocks, or you do it across assets?
So I do it primarily in stocks or stock indices. So you bring up a good point there. Like if you're looking at mean reversion, what I have found, like in the U.S., the S&P 500 is a great mean reversion vehicle. Even stocks within the S&P 500 mean revert pretty well. But if you take some of the like a mean reversion system that might work great in the S&P 500, it might not work very well on things like gold or bonds or anything like that. And part of the reason for that, I believe, is that the S&P is somewhat diversified, right? Like people can be looking to get out of financials and into energy, or get out of consumer discretionary stocks and get into whatever else, pharma or utilities or whatever it is. So there's always a little bit of push and pull, right? Where something's selling, something else might be buying, and that leads to the kind of mean reversion. But if you're trading gold or bonds, it's pretty much one direction, right? Like it's gold's going up that day or gold's going down that day, and you tend to have more follow through on a day-to-day basis than you would in something like the S&P 500, where there's more diversification there. So if you're trading the mean reversion system, there are vehicles that it could do well for, and there's some vehicles where you're better off trying to trade a breakout or trend following type systems instead.
Got it. Got it. And when you are doing stocks, do you do it as a basket of stocks, or do you do it even in individual single stocks?
Well, both. So I'll trade ETFs, the healthcare ETF or the utilities ETF, or it could be a country ETF or SPY or Qs or something like that. But it might also be an individual stock, right? It depends on the model. I think I mentioned earlier, I only trade large cap stocks. I don't trade small cap. I don't love them for mean reversion. For one, you don't have the same sponsorship, but also you get more slippage, right? I want there to be plenty of liquidity in the stock that I'm trading. And you don't necessarily have to do, large cap stocks. You can filter by the most liquid stocks if you want. I mean, sometimes there's plenty of liquidity in some small stock over a time period because it's in the news or whatever it is, and it might not have gotten into the S&P at that point. Tesla, everyone knew about and was highly liquid before it actually entered the S&P 500. As an example.
Got it. And would your parameters be different for, let's say, mean reversion in indexes versus mean reversion in stocks? The parameters of the indicators that you use?
Yeah, there'll be some difference, but it's conceptually similar. I'm still looking for the same type of pattern, but I might be more selective. I would look for more extreme moves in individual stocks than I would require in an index.
Makes sense. Now, so today, when you are trading all sorts of strategies, it could be swing in stocks and indexes and ETFs. So you said you have like 15 odd strategies which are running parallelly. And my question is more about risk management. How do you look at these 15 strategies together? How do you manage them from a risk perspective?
I run a composite model that includes all of them. I'll look at a few different things. One, just what's my trust in the model, right? So I'm not going to give a model a big allocation. I think the biggest allocation I have to any of them is a little under 30% of the portfolio. And the smallest allocation is like 5%. And the 30% one, I'll probably move down over the next few years. But I want to see the correlation between them. I want to see, how much faith I have in any of them. And, I'll adjust based on my view of the market as well, how much I'm going to be putting into each model. If we're in if it appears we're entering a bear market, then I may increase my allocation to models that I know do well in bear markets and dial back my allocation to models that haven't performed as well in bear markets.
To what extent are these, in terms of the style, are they trend following or mean reversion? These 15 strategies, if you have to divide it in terms of what they're trying to capture.
More than half are probably mean reversion. There's a few trend following, and then there's some that I don't know if you define as either. Like I have volatility trading strategies that trade outside of the concept of just mean reversion or trend following.
Yep, yep, yep. Got it, got it. And since we are talking about this, do they all work on the same time frame? In the sense, do they all capture end of the day data, or there are strategies which work on a longer time frame as well?
No, there's some that work on longer time frames. So they might even be looking at weekly data for some of their indicators.
Weekly bars.
They all trade on daily, but some have indicators that only look weekly or could even look monthly. They're unlikely to change frequently. So like I have models that might take 10 trades a year, right? Or less. And I have models that would trade 50 times a year. And it's not consistent, right? I might have, I've got some volatility models that when volatility spikes might just sit quiet and get out of VIX positions for the periods of time. And I've got other volatility models that might take on tons of trades because the VIX is spiking. One of them looks to take advantage of short side volatility, the other is more of a long vol type trade. It's using options and things like that. So it's just kind of market dependent where the action's at.
Good. Do you have a dashboard kind of a thing where you get to see what's happening with each of these models?
Yeah. We keep a monthly scorecard on all the models, and so I know what's been working lately, what hasn't been working lately, and I measure whether they're outside of what would be expected. So one of my best models this year was struggling last fall and early in 2025. We're now in 2026, but it finished 2025 as my runaway best model. And when I say struggling, it was lagging the others, and it was in a drawdown, but it wasn't a big drawdown, and it wasn't like I had some people ask me about it at the end of 2025 because it was in a little bit of drawdown, and everything else all my other models were doing better. I was like, I don't see anything telling me that the edge is not there anymore. This is inside of what would be a normal drawdown for the model. Luck plays a part in any of them. You just miss an entry because the indicator is like off by this much, or you just miss an exit because the indicator is off by this much. That's luck. Or maybe you're using a limit entry and it just misses your limit, or whatever it is. It just gets to your limit. So there's good luck and bad luck, and it balances out over time. But even models that are quite similar to each other can have divergent performance on a month-to-month basis, just based on luck. So having multiple models working for you based on multiple concepts and with low correlation to each other helps to reduce the impact of luck. But if your model does really well for a while, it's not all smarts. You're getting some good luck in there too, right?
Yes.
It's not because I'm that much better of a trader this month than I was last month. It's because last month I might have been a little unlucky, and this month I'm a little lucky.
Yep, makes sense. Now, what have been the reasons because of which you have retired a strategy from your ensemble or portfolio?
So I've retired strategies if they've gone an extended amount of time without acting as I would expect, or if they have seemed to be more correlated to other strategies than I expected, right? So in those cases, I've retired strategies. Most of my research is looking to fill holes in my investment strategy. So like, I don't need another mean reversion system that trades the S&P right now. But I could use a trend following gold system. I don't have one, right? So if it's something that'll fill in a hole, then I basically do the research. I find something I like. I never paper trade. I will always give it a small allocation on my own, because for me, paper trading is meaningless. You don't feel anything if it goes against you. You don't feel anything if it goes for you. So I'll give it at least a small allocation of my own money, and I'll trade it on my own for a while before I would ever consider trading it for anybody else. And that allocation could grow more sizable over time as my trust in the system grows more sizable over time. In the early periods, I'm also testing it to make sure that it acts according to how I would expect it to act, and also that it's tradable. Like, from the standpoint of, can I execute on it? If it's an end of day system and you want to trade it at the end of the day, well, you can only have so many of them, right? There's only so many end of day trades you can do. It's easier putting in a system that you can put in the trades at night and they'll trigger in the morning. But if it depends on entering end of day, if it's like an overnight trade, then you got to be able to manage that. And if you're missing out on trades because you're not at your desk or you got other things to do, then that can become a problem. And so I would throw out models if for whatever reason I didn't find them tradable. Or maybe you just can't get the fills you would expect, right? If it's an options system and you're trading options that have big spreads,
then your trades are not going to match the back test.
Yeah, you're not going to match at all. And you don't know that till you start actually, trying to trade it on a small amount, and then you can up the size and see if that matters. And it's got to be real life tradable as well.
Got it. So with that, I'll transition to the closing questions that I have, Rob. And right now in India, ours is a relatively nascent market compared to the US. And I observe a lot of people are moving from discretionary trading to more systematic trading. So a lot of people watching this podcast would be, going through that transition. So if they were to ask you, what would you suggest for them to become better at, systematic or rules-based trading? What would be your suggestion to them?
I would say make sure your systems are based on real edges. Whatever it is you're looking to trade, you don't need tons of rules. You don't ever want to try and filter out bad periods of time in that model. You want to look at those bad periods of time and say, okay, that may be about as bad as it gets for me, or maybe it's probably worse than whatever your back test says. So that can help to set expectations. If you don't want your drawdown to ever get worse than 15%, and your model says, hey, the worst drawdown ever is 12%, well, the worst drawdown in the future is probably more like 20. So just keep that in mind. But yeah, I would say keep your ideas as simple as possible. You want to test robustness of your systems as well. If you say, I want to trade, well, I keep going back to RSI, but it's a good example. Like, if RSI goes below 10, does that create an edge? Okay, great. What if I use 8 through 20 or 5 through 20, right, as my trigger entry instead of 10? How does that change things? And you don't necessarily want to pick the best parameter and say that's going to be the best system in the future. What you want to do is just make sure that whatever parameter you're choosing is within the range of reasonableness. And it's that range of reasonableness that's going to give you a good chance of being successful in your system. You should also want to test against random things as well. So here's a little idea. This is a stolen idea from a guy who did some programming for me. When we were testing on trading individual stocks in the S&P, the default, I think the default was initially, it would just take like if multiple stocks triggered, it would take them alphabetically, right? So you could test on different ideas, like, hey, I want to take them based on their volatility, right? So I want to take the least volatile stocks, the most volatile. But if you really want to test out that idea, you can say, all right, we'll randomize the entries rather than basing it on anything. A cool way to randomize them is rank them by their price, but just use the cents. Don't use the actual price, right? Just use the cents, because that's random, right? So if it's priced at $300.14, that gets ranked higher than $300.10, because 14 is higher than 10. And they can reverse it also. But that was a neat little way to kind of randomize results and when testing a concept.
That's interesting. So I'll move to a very different question. You observed the markets. You observed so many hedge funds, hedge fund managers. There are some who make it big, and there are some who don't. And so, what does it take for someone who becomes a big hedge fund manager, who's managing a large capital? Is it a different set of competence than just the quantitative aspects, or what does it take? What's been your observation in terms of what you've seen people around you in the industry? That's what I want to know.
Well, if your goal is to manage a bunch of the most money possible, this is not the answer you're looking for, I don't think. The best marketers draw the most money. It's not the best performance.
So it's a different competence, yeah.
It's not necessarily competence. It's the best advertisers. It's the ones that you see on TV all the time that make themselves look competent. But it's not necessarily the performance or the ones with the best ideas. The ones that are most concerned about getting you the best returns. It's
So that's exact. I expected that.
okay. All right.
So I wanted to know. So depending on that is what people who want to make it big, they should probably figure out what kind of skills they want to build.
Yeah, I mean, for people that are really interested in trading, though, you want the best performance you can, and it's that curiosity. The market's fun. It's like it's like playing a game every day, right? Or betting or putting a puzzle together. You're trying to find where there's edges and how you can take advantage of them. And there's always a scorecard. Like, choose your scorecard. You want to beat the Nifty 50? Great. You want to beat the returns of your savings account? Great. You want to target 10, 20% a year? That works too. Whatever it is. And you can set higher targets for yourself. You can say, I want to, beat last year's performance this year. That may not always be reasonable once you get experienced, because you can't necessarily control all the performance numbers. But if you can give reasonable goals, like I want to learn to implement a new type of system, or I want to learn to see if my personality fits this kind of trading, or I want to learn about trading, whatever it is, Forex, or look into day trading, or look into anything you may not be doing now. So those are more reasonable goals for people to set. You can make money doing anything.
You've been trading for more than 3 or 4 decades now, Rob, and multiple cycles of ups and downs, I'm sure you've seen. What drives you even today? Because you're still almost tracking the markets every single day. So,
curiosity. I enjoy doing it. And it's also responsibility at this point. I mean, it's not just my money I trade for clients. So, why do I trade rather than doing something else? It's just always fascinated me. And the more you learn, the more ideas you have of things to explore. So there's never any lack of something for me to go and try and study. I've got a list of 50 different things that I'm thinking of looking at. And the problem with having a list like that is, it just gets bigger, right? It never gets smaller.
and as you do those things on the list, they help you get more questions. So
Yeah.
it kind of one thing leads to another kind of a thing.
You learn one thing and it leads to 2 more ideas is the problem, right? So now you got to explore 2 more things, and that leads to 3 or 4 more ideas. And so,
Yeah.
the more you learn, the more you have to the more you realize you don't know. Right? The more you know, the more you know you don't know.
Yep.
Along those lines. Yeah.
That's there. The more, the more we think things change, the more they remain the same kind of a thing.
Yeah. The other thing I would say for new traders, you mentioned new traders, is you got to be adaptive, right? Like the market's going to change. As soon as you think you know the rules, they might change.
Oh, yes, absolutely. So when I got started, my view would have been a year or two worth of market view. And I thought that's what is market. But we don't realize, at least I didn't realize it, that those 2 years were a specific kind of a regime. And the third and the fourth year is not going to be the same. And that's when it hits you, oh boy, whether, you could be lucky or you could be unlucky, but you're not going to be unlucky or lucky all through those 4 years.
Yeah. Well, when we started talking, I talked about like that IPO second day runner strategy that I did for a couple of years. I haven't been able to trade that since 2000. So, but it was great at the time.
Yeah, traded when it did. This is a different question. Okay, so if I have to ask you about a personal trading flaw which you have not been able to work on, or you continue to kind of work on, what would that be over all these years?
A personal trading floor? I'm not sure I understand what you mean by that.
Okay, so let me articulate it again. What I meant was, you've been trading for decades now, and are there behavioral flaws which you're still working on over all these years?
Flaws. Yeah. No. So for me, not a whole lot. Like, I think it's important to not get too high or get too low when you're trading. It can be a real psychological game, like anything in life. And I've always been pretty good about, for me, I do the quantitative research to bring me back to reality. Like if I've had a really bad day in the market, doing my research kind of grounds me, where I can say, all right, today sucked, but it still looks like I got an edge. Or today sucked and it really doesn't look like I got an edge anymore. I better get out, right? And then I can get flat and get out. My favorite market psychologist is Brett Steenbarger, and I would recommend people check out his books and his website. It's
His blog.
His blog, yeah, he's very good, and he's got a lot of good ideas. He's a great person. I would highly suggest you check him out. It's his last name is spelled Steenbarger.
I have one last question. What does your life beyond market look like?
Well, I got a couple kids. They're getting older now. One just graduated college and he's off in the real world, and my daughter is in college. And in my spare time, I like to ski and play tennis, and I play platform tennis in the winter, which is kind of like pickleball, but it's outdoors in a chicken wire cage type thing that you play off the fences and stuff too. And it's a outdoor winter sport. Markets, travel. I like to travel some. Those things. And we root on all the local teams here. So I like going to the Celtics games, the Patriots games, and all that.
Got it. Thanks, Rob. Thank you so much for taking time out and answering all questions that I had, and all sorts of questions that I had. And I'm sure people who would listen to this conversation would benefit from our questions and answers. So thank you so much. And I wish for you, you continue to trade, you continue to research and write. I'm sure we all would, gain by that.
Well, thank you. I really enjoyed getting to talk to you. It was my pleasure, and I appreciate you inviting me on the show. I was humbled to be able to do it. So thank you.
Thank you.